All right, I think we're going to get going. Again, thank you guys all for joining me. For those of you that are over on our side of the United States, more West Coast, this is still a little bit early for us, so 3 in the afternoon, but I know many of you are from the other side, so thank you for taking time out of your evenings with your family and joining us. Again, my name's Heather Dreves. I'm with Central Lending, and I'm pretty excited about this. For those of you that know me, I have done webinars pretty consistently on a monthly basis for a while. Took a little break over the summer, had some feedback that a lot of people were busy, and so we decided to kick it off in September, and we're going to start having these once a month. And I thought there was no better time than the present to talk about due diligence on fund managers and operators. A lot of you that are clients of mine that I've worked with for many years, we have these conversations, and it's the same conversation that I have with new clients. I believe strongly in our investors diversifying their portfolios and encourage them to look at other fund managers and operators, but want to arm you guys with the education that you need to make educated decisions about how you're going to invest your dollars and where you're going to invest them. So we're going to cover due diligence on a fund manager and operator tonight. For those of you that don't know me, I've been in the fund management and the private money industry for over 20 years now. I live up in the Pacific Northwest. I live in a beautiful part of Idaho, northern Idaho. We joke around here that it's terrible, and we tell people there's lots of bears and bugs, but it's very beautiful. And if you've ever been here, you would know that. But if you ever get over to our neck of the woods, I encourage you to let me know so we can treat you to lunch or dinner or something like that. This is a picture of my family, my husband and my 2 boys. We are active real estate investors. We are passive investors as well. We utilize the strategy with our self-directed IRAs. And we deploy capital into notes and real estate funds in a more passive environment. Now, somebody is telling me I am muted and that they cannot hear me. Cade, if you can give me a shout out and tell me that you can hear me. Cade is saying that he can hear me, so I'm going to keep going. If any of you are having any audio problems, let me know through the chat section, and I'm happy to address that. But it sounds like Cade, who is actually on the presentation, can hear me just fine. So we're going to keep going. A little bit about Central Lending. So for those of you that are new to Central Lending has been in the business since 2017. We are a private lender, and we are a fund manager. We are also an active real estate investor in the Florida market. For those of you that don't know, we are located in a town called Lakeland, Florida, which is about 45 minutes inland from Tampa. It's a beautiful little town. I've been lucky enough to visit there. And we are a small company, but we do quite a bit of origination and capital raising. We are really honed in on focusing on things that we're really good at, instead of trying to be everything to everybody. So we lend money to active real estate investors that are mainly buying residential properties, so single families up to 4 units. And they're looking for bridge financing. So they're looking for short-term financing, usually to buy the piece of property, and then also typically go in and do a value add, rehab it, and then they're exiting our bridge loans by either refinancing or selling the property, or sometimes they come in and pay us off with cash. We like that too. So again, we're out of Florida, Central Florida. We do buy real estate in that market because that is where we are located. But anywhere outside of Florida, we are not buying real estate. But we do have a pretty broad reach from the private lender capacity. So we will lend in multiple states. So, a lot of people will call and I ask them, because I think, again, it's important to diversify, and I'm always interested to hear who they're looking at and what kind of information they're getting, and maybe who they're currently invested with. But many times I'll talk with people and I'll ask them, and I think due diligence is kind of a buzzword. So, I thought it was worthwhile to talk about what exactly due diligence is. But before I really get into the meats and potatoes of this presentation, I want to make sure that you guys all understand this is for educational purposes only. I am not a financial advisor. Central Lending does not give financial advice. We are not accountants. We are not attorneys. Alternative investments are no different than any other kind of investment you do. There is risk in any investment that you make out there. And it's extremely important that you, as an investor, are doing your due diligence on these types of investments, whether it's something with central lending, another fund operator, or your more traditional investments that you can get involved with. So again, this is just for educational purposes. I'm not by any means giving you financial advice. I am giving you my opinion of what you should be asking, but it really is your sole responsibility when you're out there looking to explore alternative investments as well as traditional investments, to do your own due diligence to make an educated decision whether you want to move forward with an investment. So technically, due diligence is the process of scrutinizing an investment. And I like to emphasize this before venturing into it. It focuses on the steps that an investor follows before entering an investment agreement. I can't tell you how many times I talk to clients that say, well, I invested with so-and-so. He promised me this high rate of return. I made the investment and 6 months later, things weren't going that great. And I started doing due diligence. Again, due diligence is something you guys need to be doing before you actually make the investment, not after you make it. It's extremely hard to unwind an investment after the fact. So again, do this before you're venturing into an investment. And this is how you're going to scrutinize it. A few reasons why I think due diligence is crucial. It reduces your risk. This is going to ensure you're investing with a confident, transparent, and reliable fund manager. One of the biggest things we talk about at Central Lending is not just the kind of rates of returns that we may potentially be able to provide an investor. How do we ensure that we are putting capital preservation first and foremost? And I think that's the most important thing, right? Everybody wants to get the highest rate of returns they can on their investment, but in the most reduced risk environment. And the biggest question a lot of people have is, hey, could I lose all of my investment? So when you're going through a due diligence process, I think this is one of the things that helps you reduce your risk going into these investments. It's going to help you maximize your returns. It's going to align your investment goals with a manager's expertise and track record. And I've got a little story about someone just recently that's trying to maximize returns. And I'm going to talk a little bit about that. And then it also is going to help you guys identify red flags. There are things on the surface that, and I tell investors this all the time, and I use this for my own investments. Sometimes when things seem too good to be true, they just might be too good to be true. There's a lot of red flags. Use your intuition, by going through a detailed due diligence process, and some of the things I'm going to educate you guys about today, you might uncover potential issues that you probably wouldn't have seen had you not asked some of these questions. So due diligence, again, is so important. However, I also believe that many times I talk to clients that, are armed with some of this information, and they start going through their checklist, do you guys do this? Do you do that? But they never have an idea of what they're really trying to accomplish with their investment dollars. So I tell people you could get, I call it analysis paralysis, right? You could interview 20 of us operators out there, but if you don't have an idea of what you're trying to accomplish and answer some of these questions I'm going to show you next, you're never going to be able to make a decision. And you might determine based off of these questions that you should be asking yourself that maybe central lending isn't even a good fit for what you're trying to accomplish. So I think you really need to sit down, whether that's with yourself or a partner, and if you're investing with a spouse or a partner or anything like that, you need to answer a few questions before you even start getting on the phones with operators like us or fund managers. So first question is, how much are you looking to invest? Alternative investments many times are syndications, are funds, are, the purchase of a promissory note. And more often than not, they have what's called a minimum investment. So if you're out there trying to invest $5,000 to $10,000 and you're talking to a bunch of operators whose minimum investments are $100,000, that's probably not going to do you a lot of good. There's no reason to even be having that conversation unless you maybe are coming into more capital down the road that you may be ready to invest. Then I can understand that. But really understanding how much money are you looking to invest? Because again, many of these investments have what we call a minimum investment. Um, what kind of dollars are these? And what I mean by that is I think that your decision to invest with different operators may change based off the kind of money you're trying to deploy. So examples of that are, many times people are trying to deploy cash, right? This is money in their savings account. This is, money that they have in their nest egg that they prudently saved over the years. A lot of times, and more often than not in this industry, people are deploying what we call IRA or tax deferred accounts. So Roth IRAs, traditional IRAs. These kinds of dollars are set up with what they refer to as self-directed IRA dollars, meaning you are self-directing where you put those dollars instead of going to your money manager or a financial advisor. You're making decisions, but these are very powerful ways to invest your dollars that are either tax-free, like a Roth, or they are tax deferred, like a traditional IRA. And the reason I say that it's important to identify this is what you're trying to accomplish with that investment might be different with those types of dollars. For example, many times people with self-directed accounts want their money just out there working all the time. They're not necessarily trying to create cash flow and replace income, because those are, again, tax sheltered accounts, and there are rules and regulations as to how and when you can access them without tax implications. So maybe with a self-directed IRA, you're maybe looking for a fund where you can reinvest your earnings. So you don't have these monies going back to your self-directed account sitting there undeployed, versus cash dollars. Maybe you've sold a practice or a business and now you're trying to strategize and replace your income and create monthly cash flow. Those types of investment strategies are obviously very different. And depending upon how an operator's set up, how often they pay out, that might make a decision real quick. So understand what kind of dollars these are. And they could be both. I have a lot of investors that deploy both types of dollars. And many times they're making decisions on where they place it based on what kind of accounts those are coming from. Another big one I talk about is how long are you planning for your capital to be tied up? I've had clients come to me and say, listen, I've got kids that are probably going to be entering college in 4 to 5 years, or even less, 2 to 3 years. How long is your minimum tie-up period? If you are needing to access your capital in 1 to 3 years, I don't know that maybe a syndication is the right thing, because a lot of times your dollars are tied up for at least 5 years. And once you're in with a syndication, because you're going in as a partner in that, you don't have the ability to pull your money out until the project is completed. Where a evergreen fund may have a 12-month tie-up period, so you are committed to leaving it in for that 1 year, and then after that you can exit it. So it's important for you to understand, when you start to identify these buckets of dollars that you're investing, also identify how long you want those dollars invested for. And it could be longer and it could be shorter. But if you get into a syndication where your capital's tied up for 5 years and you're thinking you're going to go after 12 months, pull that money out to pay for your kids' college tuition, that's probably not going to happen. So again, understanding how long you want your money tied up. This one is one I just mentioned. What are you trying to accomplish? Are you trying to accomplish cash flow? Which is very realistic. I'm dealing with my mother-in-law right now that has her whole nest egg invested in the traditional markets. And for the last 10 years, she has been getting $500 a month from her Edward Jones guy. And she was under the impression that's how much money her account was making. Well, bad news is they were reducing her balance by $500 every month, pulling money out of her account. So her account was earning like 2 or 3%. She's a perfect type of client that needs cash flow. She's supplementing her Social Security, but it's important to understand Am I trying to create cash flow? That might be a different model. You're probably going to look for an investment vehicle that pays out on a monthly basis, or if you're really diligent about budgeting, quarterly might work for you, versus a growth model where you might possibly still be working and you have income coming in. And your whole goal with your investment dollars is to find an investment with the best yield possible, but also the ability to reinvest your earnings and create that compounding effect. So it's important to know that, because if you're investing in, a fund that doesn't give you the ability to reinvest and they're paying you out every month, well, now you've created cash flow, which also could be income implications if you're not looking for that as well. So really sitting down and honing in on this is important. This is something that some of my investors are really, hung up on geographical locations. Hey, I live in Texas. I only want to invest in projects in the Texas market. And that's totally fine. But if you do that and you're in a debt fund that lends all over the United States, that's probably not going to fit your appetite. So you may or may not have a geographical location um, uh, preference. But if you do, it's important to understand that, because you can start talking to operators. Hey, where are you investing in projects? And some operators are really honed in on their local market. It's not out of the question to be able to find a good operator that only invests in certain specific markets. But there are a lot out there that are in several markets. So if that's, a big no for you as far as being more geographically diversified, then you need to know that up front when you start talking with operators. Asset classes is another one, in this alternative space. I mean, you can be invested in projects that are self-storage, projects that are apartment complexes, something like central lending. We focus more on residential affordable housing market, land development, mobile home parks. You may or may not have an opinion about that, but if you do, it's important to and I tell people, write this stuff down. Like literally sit down and do bullet points for this, because then when you start talking with companies and operators like central lending, you can decide real quick, okay, great, they're, not in a market I'm interested in. I can't create a growth model with them, whatever the case may be. Because again, you will get analysis paralysis. And I've talked to these clients and they'll have a notebook full of operators with no idea of what they're even trying to accomplish personally from an investment strategy. And if you're not sure about that, there's a lot of great organizations out there that can help you kind of strategize. That's going to teach you, tax advantages. They're going to teach you how to create cash flow. I'm happy to pass you some information along to other companies like that. Again, we don't give that type of advice, but if you're looking for it, let me know. And then this is the last one I'm going to say is know your criteria for saying no. And it's okay to say no to an operator. If your investment goals and strategies do not align with that operator, you need to know, hey, maybe you have 5 things on your list and 3 of them are hard no's if they don't do, right? Know your criteria for saying no, and it's okay to move on to the next operator. All right, key areas to investigate. So these are areas with an operator that I believe pretty strongly in that you should really dig into. One is going to be background and experience. The second is going to be what is their track record? Has this operator done this before? And the things that they need to share are not just the wins, right? Like, tell me about a deal that didn't go as planned. How did you handle that? Their investment strategy, and their transparency and their reporting. And then lastly, regulatory and legal compliance. And then part of this also with regulatory and legal compliance, also with transparency reporting, will be the fee structure. So we'll talk a little bit more about that, but let's dig into sponsors' backgrounds and experiences. So fund managers' history, again, how long have they been doing this? Doesn't mean they have to be doing it for 20 years, But as an investor, I would want to know, what's their experience been? Have they been through some of the bad times? Everybody looks good when markets are great, right? What I would want to know is, hey, how did they handle COVID? Were they in the markets in 2008? How did they handle that? How did their funds perform? Educational background, professional qualifications, key team members in that firm. What were their past firm's roles? Where has their manager worked before? How have they performed in different markets and environments? One thing with sponsors is the team, right? One of the biggest concerns I would have as an investor is if there was a single point of failure, if there was just one person there that was making the wheels turn around. It's important to have a team and to not just have the team, but talk about those things. Like, talk about, hey, what happens if so and so isn't here anymore? People get sick, people leave. How do they fill that void? And what is everybody's experience in that industry? I can tell you at Central Lending, there's three of us that have executive roles. We all have different strengths. One of us is great at deals, finding the deals, working with sales executives, originating, actually doing hands-on real estate flipping. I'm really strong with investor relations, reporting, raising capital. I can also fill in as an underwriter. I've serviced loans, so there's a lot of holes that I can fill. And then we have someone that's extremely strong at operations as well as servicing and all those kinds of things. So in understanding the team players, what their past roles have been, what is the industry's reputation? And this is one that people don't ask for enough. I encourage people, hey, would you like a reference? I would get online and look at reviews. I would tread lightly with online reviews only because more often than not, the only people that get on there are people that are upset, which is fine. But there's also, I think, a balance. You want to talk with people that, have gone through tough times, maybe with that operator, and then also came out on the other end and seen how they handled that. And a third party reference can be someone that's done business with me for 20 years and followed me from one firm to the other. So getting the names and numbers of people that you can call and get references for, I think, is a great strategy. I don't think enough operators offer that. And if they're not offering it, I would ask. And if they are not inclined to give you that information, that would probably be a hard no for me. So tip is, look for managers with a minimum of 5 to 10 years in managing similar types of investments. The managers that would concern me are the ones that are all over the place, trying to do commercial, self-storage, residential. I would look for somebody that is really honed in on their niche as well. So track record, let's talk about historical performance. I would ask to see returns for 3, 5, and possibly 10 years. They should have that information. We use a third party, Dreves, that does all of our monthly financials, and we have the ability to pull these track record reports, and you can see exactly every single month what we have paid out and what our earnings were. I would ask what their consistency is. How have they performed in good markets as well as bad markets? And that again alludes back to the sharing of information, when a project went really well and projects that didn't go really well. I would want to see an operator that had been through, a poor market and seen how they came out and how they handled it. Risk-adjusted returns, compare their returns relative to the risk. So this is interesting because this came up recently with a client of ours that is a very sophisticated client that is obviously trying to maximize their returns. And we had a conversation with him recently with myself and another staff member and our CEO. And this client had mentioned that they were trying to get the highest yield they can with the lowest amount of risk. And those two words are just not used in the same sentence. You cannot get the highest yield with the lowest amount of risk. So that's what this is talking about. What is your risk-adjusted returns? How risky is the investment that this operator is offering? And is the returns in line with the risk, right? So If their returns are extremely high and they're trying to tell you the risk is very low, I would probably dig deeper into that, because that's not the way that the private money industry and any investment works, right? The more risk you take on, the higher your yields should be. And so that's another thing you need to talk about before actually digging in with operators, is like, how much risk are you willing to take on? Benchmark comparisons, have they consistently beaten the relevant benchmark? So if their projected returns are 10%, have they been hitting those? Or is this just a number that they threw out there? So watch out for cherry picking data or excluding bad years. Again, you should get the good and the bad, and they should be very transparent and open to giving that to you without you even asking for that. And I think that goes back to historical performance. That's where you're going to see that. If you see a lapse in that, maybe they give you the last 2 years and then they give you 4 years and 6 years back, and there's a period of time that the reporting isn't in there, I would start asking questions about that. What are their investment strategies and their objectives? This is another one, and we talked a little bit about this, with your guys' questions you should be asking yourself, with the geographical areas and things like that. This kind of plays into this part of it. What is their approach? Is their strategy clear and understandable and aligned with your risk tolerance? For example, if you are not interested in investing in mobile home parks and you are getting into a fund that mainly lends money to people that own mobile homes, that is not in alignment with what you're looking for, right? So is their strategy clear to you? For example, we have a debt fund. Our strategy is that we lend money to real estate investors, so non-owner occupied loans. We lend on residential real estate up to 4 units. It's very clearly defined in our PPM. So I would ask them, can I read your private placement memorandum? And make sure that you understand their strategy. And if you do understand their strategy, does it line up with what you're looking for? Research their process. How do they select investments? What due diligence do they do to perform on their investments themselves? We are a debt fund, so we have a very clearly defined underwriting process. We order a third-party evaluation. We do quite a bit of due diligence on the actual borrower. We pull credit, we pull background reports, we order title insurance, and then lastly, we are also asking for a contractor's bid for the rehab project. So understanding how they do that due diligence, and it might be, hey, we go out and buy self-storage units, which is a great strategy, but what does their underwriting process look like? So they should be able to communicate that with you. Portfolio management. How diversified is their portfolio? What's their approach to risk management? This is a big one. Not all offerings are diversified, meaning that they have multiple assets in them. Many of your syndications are going to be single assets. And that's fine as long as you understand that going in, versus maybe a debt fund that is lending money out to other investors and it could have 400 assets in it. That's probably more diversified than a single asset syndication. But understanding that, how diversified is their portfolio, what assets are in there, and then how do they manage it? If you're managing a debt fund, how are they managing borrowers making their payments? Are they doing that internally? Are they using a third party to collect payments? If it's a multifamily, how are they managing the rents? Are they using a property manager? Are they trying to do that internally? Market fit. Is the strategy suitable for the current market and environment? And I think that could really depend on the area, the geographical area, and so those are things that you need to look at. Is the current market that this asset in the best strategy that they are utilizing? As for examples of how the strategy has applied in different market conditions, there's nothing wrong with asking for more documentation and information. This is a big one, and this is one I hear almost on a daily from clients that say, I invested with this other operator and we haven't heard from them for 10 months. And I will ask them, well, did you Did you inquire about how often they report and how they report to you before you made the investment? Well, no. Okay, well, you need to first and foremost contact them, but you should have probably asked that information up front. You know, single asset syndications, there's not a lot of reporting, right? Like they collect rents typically, and they're paying you a preferred rate, and they might pay out additional profits above and beyond the preferred rate at the end of the year. So there's just not a lot of activity versus something like our fund, which is a debt fund. We are originating new loans daily in there. There are borrowers' payments being made. We are selling loans off. Loans are paying off. There's a lot of monies going in and out. So we report on a monthly basis. If you're in the equity fund, we report on a quarterly basis. But again, it goes back to understanding and asking those questions. So how often will you receive performance reports? Is there real-time access to portfolio details? That's not as common with a debt fund. That might be a little different with a syndication, but at least asking that. Do reports include fees, performance breakdown, and risk analysis? We get very detailed financial reports every single month from our third-party partner called Verivest, and it is a full-on profit and loss of the fund. And we provide that to our investors. But again, you need to ask that. Is that something that you can expect? What is their communication like? Is that manager accessible for questions and updates? Are they proactive? Do they provide relevant information? This is something I hear often too. Hey, I made my investment with this other operator and now I can't get a hold of anybody. And how do they communicate best? Are they giving you their cell phone and you have access to them? Are they best if you email them? Do they have an online portal? We use an online portal where people can actually go in. They can see their earnings at the end of the earning period. It doesn't change on a daily basis, but at least once a quarter, and some of our funds report on a monthly basis. But these investors of ours are our clients, have the ability to see their reporting as soon as it's updated and it's all online. Statements are held there as well. K1s, you can even communicate through it, or you can just call us. But again, communication is the big one. I think, at least for myself personally as an investor, I want to know at the end of the day if there's any questions I have or concerns that I have, whether they're validated or not, that I know that somebody's going to pick up the phone on the other end and answer my questions. Like I said at the very beginning of this presentation, investing does not come without risk, but I think what everybody wants to know is if an investment is having challenges or I have questions and concerns, I want to know at the end of the day that someone's picking up the phone on the other end of the line. So ensure that the manager provides full transparency on both successes as well as losses. I think that's always been my motto, is transparency, and all of my clients have all said, hey, we're sophisticated investors, we understand there's risk in this, but what we want to know is that you're going to be transparent about it and you're going to let us know what the plan is if there's any challenges. So ask these questions, because the time to ask that is not after you've made the investment. If this operator you invest with only reports once a year and you're expecting monthly reports or even quarterly, you're going to be very disappointed. And there's nothing that you can do about it either. Third-party services. So this is a big one. I see some very familiar names on the presentation today. So thank you guys for joining. It's nice to see familiar names, and I see a lot of new names. There has been a lot of disruption in the alternative investment world. There has come to light over the last probably 18 months, operators that were not above par. They weren't doing the right things. They weren't transparent with their investors. They were having challenges, and a lot of investors didn't find out till it was a little too late. I'm a firm believer in third-party services, and what I mean by that is you still, as an operator, need an internal team to manage a fund and its assets, whether it's multiple assets or a single asset. I also think it's very important to have third-party services that are making sure operators are doing the right things, that the numbers are correct, and also compliant. So a few of the things to talk about with third-party services is custodian services. These are the types of third-party services that safeguard the fund's assets by holding and administering securities or cash on behalf of the funds and its investors. We have trust accounts all set up, so these are third parties. We also use a fund administrator, and that is not required by the Securities and Exchange, but Central Lending believes really strongly in using a third party fund administrator that looks at the day-to-day administrative tasks such as accounting, valuation of assets, investor reportings, fee calculations. They work hand in hand with our accounting team. So we do internally have an accounting team, but what the third-party fund administrator does is at the end of every month, we report to them our balances, all the transactions, and they confirm that all of those things happened, and then they provide us detailed financials. For example, if Charlie says that he invested $50,000 on the 15th and our fund administrator looks at our bank statements and doesn't see that deposit into our account, they're going to start questioning, hey, Charlie said he invested with you guys. Where's this money? They're also going to confirm and match up transactions. If we say, okay, we wired out to fund this loan on this date and we don't see that coming out of our bank account, or we say we paid out earnings of XYZ and they don't see that coming out of our bank account, they're going to start to question that. So that happens on a monthly basis. Third-party auditors is another big one. But the thing that I forewarn people is third-party auditors audit once a year. A lot can happen in 12 months. So that's why I feel so strongly about the fund administrators that come in on a monthly basis as well. Again, audits are not required. Fund administrators are not required. But in my opinion, a put together and a transparent operator is doing these things. Obviously, compliance consultants or legal counsel, what this is going to do is make sure that our fund is complying to state laws, federal regulations with the Securities and Exchange. Attorney legal is going to make sure that our fund documents are prepared properly. So these are the PPM, the private placement memorandums are prepared by legal, as well as the documents you would sign if you made an investment with us also. And this is important, if you aren't filing your blue sky laws in every single state that your fund is raising capital in that requires it, your fund can get shut down if you're not filing the right exemptions or regulations with the SEC. Your fund can be shut down too and put the other investors at risk. So it's really important to be using those types of third parties. And as a investor, when you are doing your due diligence on operators, it's okay for you to ask those questions and ask who they're using for their legal counsel. Loan servicers. This is a third party that manages the ongoing administration of loans with debt funding. So for example, we lend money to lots of real estate investors. We have, upwards of 450 loans in our portfolio. That would take a massive staff to collect all those payments. So we use FCI Servicing, which is a third party. They collect the payments from the borrowers. They disperse the payments to the lenders, many times, which is our funds. And then internally, we have a team that helps manage that. If a borrower's not making their payments, they're calling. But what we don't want to do is be touching borrowers' money. So we leave that to the experts with all the licenses and the errors and omissions. And they're doing the collection of the payments. They're applying the payments to the loans, and then they're dispersing them to the investors. It's not required. There are a lot of operators out there that do them themselves. There's nothing wrong with that. It's just the amount of staff that would take. It's not cost effective for us to do that internally, although we do have quite a team that manages it. Again, we use a third party for our loan servicing. And I want you guys to add any questions that you may have as we go along too. I forgot to mention that. I want this to be interactive. We do have a hard stop at the top of the hour, so I want to make sure that we get through everything and have some time for some questions. So we will continue on. Regulatory and legal compliance. Again, this is your licensing and your registrations. Are they registered with the SEC? If they have to be registered in the state that they're raising capital in, are they doing that? Those are blue sky laws. You can ask and search if they've had any disciplinary history. Have there been any past violations, lawsuits, or regulatory actions? Some of those, if they do have them, could be very well explainable, but it's nice to know. It's not great to find out after you've made an investment. Does the manager have a strong compliance program in place? What are their internal controls? So what kind of processes and procedures do they have set up internally? And then, just a tip, confirm their standing with the industry regulators before proceeding. You can search that at the SEC and you can see if, somebody's fund isn't registered. Again, it's important to look at. We live in the world of the internet. You can find just about anything if you search hard enough. So there's no excuses not to look for those things. Fee structure. This is another one. So I'm just being transparent. We are a for-profit company. We are not a nonprofit. But I can't stand when operators aren't open and upfront about how they make money. And you guys should be asking that. Hey, Joe operator, how do you guys get paid? And if it's not clear and it's not clearly defined in their fund paperwork, I would keep digging, because that would be a red flag for me that they're trying to hide something. So typical fee structures. First and foremost, most funds are going to charge a management fee. And this is typically a percentage of assets under management. So, for example, a management fee industry standard could be anywhere from 1% to probably 2.5%. So asking them, hey, what kind of management fee do you guys get paid? And I will tell you, management fees keep the lights on. You guys want a team there managing the fund or the syndication that you're in. They're not going to do it for free. But is their management fee they're charging reasonable within the industry, right? If they're charging a 5% management fee, I would probably question that. One of our funds has a 1% and the other one has a 1.5%, just to give you an idea. Again, management fees keep the lights on and pay the staff to manage the assets in the fund. And then the second thing I would ask is, what is your performance fees? Are there any incentives to a fund operator for their fund to perform? So typically what that means is, when a fund pays out profits and earnings, it's going to pay out a management fee first. Typically, there is what's called a preferred rate of return. So that is the next dollars that are paid out to the investors in the fund. And the thing I would warn you about preferred rates is ask if they are cumulative, which means, do they get caught up if they're not met in the paid period or in the earning period? So performance fees are paid above and beyond that preferred rate, or some people call it a hurdle rate. So we set ours up where we pay our investors a 9% preferred rate, and then everything above and beyond that in the performance fees is split 75-25. So the additional fees above 9 go 75% to the investors, and then we get an additional 25. That's what incentivizes us to get that return on the fund up there above and beyond 9%. So those are performance fees. Are all fees and expenses disclosed up front? This should be disclosed and very transparent. It should be in their PPM or their offering documents. They should be telling you about it. It should be in any marketing material. And if you don't see it, ask. And again, are these fee structures that they're offering reasonable in the industry? And once you guys start interviewing some operators, you're going to see everybody's are about the same, but if you see some that seem excessive, that's probably a red flag for you. And if they're also hiding their costs and fees, that would be a red flag for me as well. So key red flags to watch for. So these are some of them that you guys, as you're starting to interview operators, again, look for these things. Inconsistent track records. I would look for large discrepancies in returns across similar time periods. lack of transparency, if they're unwilling to provide you with information you're asking for, whether that's performance information or fee structures, that would be a big red flag for me. Just because you don't see it right, like blaring at you when you start looking at their offering documents, doesn't mean it's not there. I wouldn't panic yet, but if you do not see those things and you start asking and they're unwilling to give you that information, that would be a red flag for me. That's a hard no for me, quite honestly. Remember that list at the beginning. Know what is a no for you. That's a no for me. High turnover. This is a tough one. Frequent changes in key team members or management. I think high turnover in the sense that everybody's quitting and every time you call there's a new person. That would be a concern for me, like, internally what's going on. However, if key team members are moving up and being promoted and they're adding to their team, that's a little bit different story. But high turnover where people are just leaving, whether that's because they choose to leave or they're let go, that would be a concern for me. And excessive risk taking, using complex strategies, leveraging without clear justification. Those are things as well that I would watch for, that may be a red flag. And again, these types of things, you guys need to decide what your risk level is and what your things are that are a hard no for you. It may mean that some of these things come up and you just need to ask more questions. And I think that's the biggest thing I see from investors is they don't ask questions. They get the information, they really don't look at it all that closely. They don't ask any additional questions. They chase yield. This is like, if there are two things I could advise you not to do, is chasing yield, trying to get the highest return out there that you can, and not diversifying your investments, putting all your eggs in one basket. If I could give you, if that's the only advice you take from this presentation, then I did my job. Do not chase yield and do not diversify and put all your eggs in one basket. And I think if you can follow those, and again, this is just my opinions and my advice. I'm not a financial advisor, but I've been in this industry long enough. I've seen operators go sideways. I've seen investors make bad decisions. And a lot of this content comes from the years that I've been talking with clients and seeing things that maybe could have been prevented if more questions were asked and there were better processes in place and there were third parties being used. So again, take it for, what it's worth. I'm just trying to arm you guys with more information and questions to ask when you're talking with the operators. And there is a due diligence checklist. Robin just asked, and we will be sending that out for you guys so that you guys can be armed when you do start talking with operators. Additional resources for due diligence. So again, these are places that you guys can go to do more homework on an operator. Obviously, regulatory filings, the SEC, you can go to most Department of Financial Institutions in the particular states. Not every state requires a fund or an operator to register with them. So depending upon which state you're looking in, it may not be on there. But even though our fund is only for accredited investors, we still have to register with the SEC for an exemption. So at bare minimum, a fund or a syndication should be filing for a exemption with the SEC. Third-party platforms. So we use Verivest. You can go there. There are other organizations that will actually perform a due diligence on an operator for you. They're fairly costly, but if that's something you're interested in, they're out there. And then again, industry contacts. Reach out to previous investors. The best source of information that you can get is from somebody and a referral. And quite honestly, this is how this industry kind of works. I get calls all the time. Hey, my neighbor's invested with you. He's had a great experience. My mom's trying to create cash flow. Could we talk about investing her dollars? So ask your friends. I think in the past people didn't talk about their finances, but there's so many online groups where you can network with people. You can get on them, ask, hey, have you ever invested with central lending? What's your what was your experience like? So I think asking around for referrals, if you don't know anybody that has invested with that operator, ask the operator, hey, can I get a couple references? So it's okay to ask questions. So again, best practices, ask questions. I can't stress that enough. Engage with the fund manager to clarify any doubts you have. Verify their information. If they're telling you one thing, check that. Make sure it's actually happening. Make sure that what they are doing is aligning with your goals, your philosophy, and your approach, and never rush due diligence. I mean, take as long as you want. And if that operator is pushing you to make a decision, that would be a big red flag for me. All right. I have a couple other questions. I'm going to get to those as quick as I can. We have a countdown. We've got 5 minutes left, but I want to make sure that I can address your questions. But I do want to make note, we are having another webinar next month. So we're going to do this every single month. Next month, we're going to focus on information and education about investing in promissory notes, or what they call one-off notes. So I'm going to talk a little bit about how to dig into a file, what you should be looking for. We'll give you some real life examples, but that is going to be next month. We do not have a date yet, but because you attended or registered for this webinar, you will definitely get an invite. And share if you have family, friends, colleagues that might be interested in this. Please, by all means, invite them to this community. My goal is to grow this, and for this just to be an educational platform for you. We're going to have some guests appear. I'm in the talks with getting someone from a self-directed IRA custodian, so hopefully that will happen in November, and you guys can ask all your questions about tax deferred accounts, because that's another really great strategy for you guys to invest dollars in a tax sheltered environment. If you want, and you want to schedule an appointment with me, I am always happy to do that, answer more questions you guys might have. If you follow this QR code and just put your contact info in, there's a note section in it. And you can just let me know, hey, I want to talk about this, or hey, just want to touch base and learn more about what you guys offer. Just fill that form out and I will reach out and I'll schedule a 30-minute call with you. No obligation. I'm really, yes, I help people deploy their capital in these types of investments, but more than anything, my passion is to educate you guys and arm you with enough information to make good, educated decisions about investing your dollars. We also have a fund manager due diligence book that we will also provide you with. So if you're interested in that, fill this form out as well and just put in the notes, hey, looking for the due diligence book. And it's a digital download. It's not a hard copy. I'm not on Amazon bestseller yet, but it's just information to arm you guys with when you're out there, looking for other alternative options to invest your dollars. Okay, let me get to a few of the questions. Let me pull them up on my question section real quick. I hope you guys enjoyed this, and I hope we grow this community. And if you guys have any topics you want me to cover, shoot me a message too. Okay, so quick. What if you're not an accredited investor? So in order to invest with central lending, and most of these investments like syndications and things of that nature, you do have to be what's considered an accredited investor. So that means you either qualify through your assets, which means you have $1 million or more in assets. You cannot include any equity in your primary residence, or you can qualify as an individual with annual income of $200,000 a year or a household of $300,000 a year. So it's one or the other. If you are not accredited, you can buy promissory notes from us. So I'm happy to talk to you about that. That's still a really good opportunity. So don't worry, there's still options out for you, but at least with central lending's funds, you do have to be an accredited investor. Is my rate guaranteed? I'm gonna probably scare a bunch of you off. Nothing's guaranteed. Nothing is guaranteed. And if somebody is telling you that, I would run the other way. There's risk in everything you do. Are there options where you can get a fixed rate? Absolutely. Are there options where you can get a preferred rate, which means you get paid first? So the guarantee is you get paid first, but it's not a guarantee that you're going to get paid that. and then that goes back to looking at that operator. What is their track record like? How is their fund perform? But just for clarification, nothing is guaranteed. Let's see what else. Let me see if I can hit one. Okay, this is a good one. What is a minimum investment? So with central lending, it's different than everybody else. Everybody has their minimum. With central lending, to invest in our funds, it is a $50,000 minimum. To buy a promissory note, the smallest promissory note we've funded is $30,000. So I would say anywhere from 30 to 50 is your minimum investments to deploy capital with us. But all operators have different minimums, so you would have to ask them. And there are some out there that I've actually seen that have some smaller ones. All right, we are down to 25 seconds, so I feel like I did fairly good. I'm going to have to probably set these for a little longer next time. Again, I'd love to talk with you. If you're a client of ours and you just want to reconnect, more than happy to do that. You guys all know how to get a hold of me. If you're new and you want to just explore a little bit more about what central lending does, fill that form out. So we will get you invited to the next one. We'll send a replay out of this, and thank you guys.